guys, Freaky Finance here. We're going to continue on with the earnings season theme. For whatever reason, it appears that Halloween is a big day for earnings. The 31st is jam-packed. I think I got 10 calls to try to listen to today. I'm probably not going to get through all of them. Luckily, Friday is usually slower, and so is Monday morning. So I'll try to pick up some stuff that I missed. I only try to do 2 for the purposes of the video, or else the video just got way too long because there's so many calls to go through and still think through. So anyway, this video is going to be Uber and IMAX. I thought it was a good one to do because it's so polarized. One's down 10% right now, Uber, and one's up about 8%, IMAX. So I own both of these, so that's the reason why I like to do them first, because they're more important to me. So IMAX, we're up about 53% after today's move. We'll talk about the business. It's a superior business model relative to all the other exhibitors out there. It's not even an exhibitor in my mind. It's just in the same bracket as them, even though they're far superior in terms of business model as well as balance sheet. And Mobile also reported, which has been relatively disastrous execution by management. And then, just like IMAX and Mobile, I also own Uber. Down 10% now, time of filming. We're in at about $34. Uber did some amazing things. I guess we'll just jump into it. But basically, during COVID, they pivoted really hard to delivery. And they basically built delivery up to being a material part of the business. And it was only about 10% of the business at the time of the COVID pandemic. So they did a crazy pivot. They reduced costs. The CEO, in my mind, is amazing. Dara. Probably one of the best stories of building a better product out of COVID, out of the pressures that it put on the mobility business of Uber. And with that, they're able to outcompete every other delivery platform for food, and they're also able to outcompete Lyft on the mobility side. And there's no one else really there otherwise, anywhere else in the world. And places where they can't get in, they try to buy their way in. So you'll see they own, we'll go through some stuff. They own Didi in China, they own part of Didi in China. And they also own Grab, so Philippines. And so they've tried to get in their foot in the door that way as well. Anyway, Uber is basically one of the best scaled things out there with a pretty hard moat to crack. So we'll go into it. Right now, I always like to look at the headlines just to see like what's going on. So initially it was like beat, and it was opened up down, and then all of a sudden it's plunges and then skids, and so that's what I like to see, because the results will go, like I like to be like, okay, that's what the market thinks, let's actually go through the numbers. So in terms of the growth rate, it did decel a bit relative to the prior quarter, but again, relative to where it's been and where it's probably going, it's not a big deal. But these growthier names that trade at crazy multiples react to the growth rate, especially in the short run. So you usually, for like great companies, like say, what could be interesting next week, Celsius reports, right? If I get like an even better entry to something that's already getting decimated from a lower growth rate, that'd be amazing, right? Uber's not there yet, even after a 10% correction. It's not, it's not dirt cheap like it was when we got it in the under 40, right? So, but the business itself continues. We'll go through the numbers right now. You're going to see scale across every line. The margin profile is only improved. That's across both mobility and delivery over time. And that really showed up when they cut costs during COVID, and then we saw things slowly reopen. We really started to see scale on every single line item, and that was like, wow, the business model here is special. And the market was kind of sleeping on it. So anyway, mobility is now at 8% adjusted EBITDA year over year. That's all-time high. So again, you're seeing scale everywhere. Gross bookings is very important in the long run. So whenever, like, I know it's gone from a 30% growth rate to a 24% growth rate. And it doesn't react to a slowing growth rate. So this is, to me though, it's a crazy grower. Now it still needs to grow into its current valuation, but it's like the multiple on the bottom line, if it keeps scaling like I think it can, is special over time. Delivery continues to just slowly tick up in profitability each and every quarter, almost in a straight line. And we're seeing some advertising revenue help them out there. In terms of the equity position, so this is a fun one. They have like $9 billion in CCE, but they also have $8 billion in long-term investment. And these long-term investments got destroyed during 2021 and 2022. Well, really the back half of 21 and most of 2022. They just got obliterated. So, and we saw these like huge investment losses go through the P&L for accounting. It was just accounting noise, right? You're just marking the market. And now you're seeing the flip side of that as they slowly recover. So it's kind of interesting to see them go up and down over time, and it does make an impact on what if you're gonna like not normalize the PE for investment noise. It does make an impact if you go back in time. If you're just like, why do they lose so much money in 21 or 22 and 20? Um, it scales a lot with this $8 billion because this at one point I think was over 11, and then it went down to like 4, and that was over like a year. So this thing swung $7 billion down, and now it's slowly chipping back up. In terms of the revenue side, you can see mobility is still the biggest breadwinner, but the crazy thing is delivery literally just grew EBITDA 50% year over year, which is special. Uber is still high growth mode, and one of the cool things that I like, aside from just the embedded leverage of the model, and the fact that they can dispatch drivers for both delivery and mobility, is that they can also do the advertising, which we're seeing it just only improve on the delivery side. And that's one of the reasons why delivery continues to put up better EBITDA results each and every quarter, is because they're slowly increasing the ad load and getting more foods and restaurants to advertise on the platform. Balance sheet, like I said, $9 billion in CCE, $8 billion on long-term investments, we just went through. Interesting enough, so usually I'm like, what do they do with cash, right? Because they have cash flow now, which wasn't always the case for Uber not that long ago. Interesting enough, they're actually borrowing at the same time. So they're borrowing while generating cash flow. So for whatever reason, they decided they want $9 billion on the books, on top of their $8 billion in long-term investments. So this tells me like they have started buying back shares, but they haven't even offset the share-based comp in terms of dilution. So it tells me they're thinking about doing something with the cash, and that could be an acquisition. I don't know what it is yet. So that kind of gets me curious. I mean, you can't really speculate on what it could be until it happens. I know there was a rumor about Expedia, which Derek came from. He was the CEO before he became a CEO of Uber. When they got their big boy pants on with a real CEO that can operate businesses like Derek can. What else was interesting? I mean, the P&L, you slowly see scale across the line, but you also see, even though they're starting to buy back shares, you can actually see the share count continues to go up with a dilution. We have seen for about 3 quarters now. What I'd rather see is more scale, like we saw yesterday with Google, more scale in the COGS line. But we kind of have seen it kind of keep pace with the revenue growth, and part of that is the insurance, car insurance, for whatever reason, just shot up for a lot of, especially in terms of year-over-year pain point. So that's eaten into some of the scale I think is embedded in the model. I don't think that's going to last forever. I think it's a catch-up from COVID inflation. But anyway, in terms of the other 9 lines, so operations scales, sales marketing scales, R&D scales, and G&A scales, and that's scaled since it IPO'd, and it really scaled since COVID. In terms of the cash flow, like we said, they have started to buy back shares, $372 million this quarter, but not enough to offset dilution. Like I said, they are generating free cash flow, and they're buying investments with them, just marketable securities, but they're also borrowing to do that. So that's interesting. So like, why are you borrowing while generating free cash flow while not buying back that many shares? So like, you want a bunch of cash on your balance sheet for some reason, and we don't know what that reason is. In terms of the scale, I just like to see like, here, like, well, I know insurance is affecting the margins, right? So it's 16.5% of gross bookings was cost of revenue, compared to 16% last year, right? And non-GAAP cost of revenue as a percent of gross bookings increased, primarily due to increase in insurance expense. So it's not just me saying it; it's literally written here. So that's one of the reasons why there wasn't as great a scale as there could have been on the COGS line. But overall, you're seeing scale 1.6% gross bookings versus 1.8, right? 2.6 versus 2.7, 2.6, 1.2 versus 1.4. So it's still scaling 1.3 versus 1.5. So still scaling, and that showed up over time. And see that it actually reduced employee headcount costs while growing revenue 20% year over year, right? So there is still scale to come out of this business over time, and I think its moat has only improved with COVID relative to all the other food hailers that just lose money. Deliver people, right? I don't know. It's just best in class. I think they have first mover advantage by a mile on Lyft. Lyft isn't even close to what Uber is, especially worldwide. If you zoom out in Canada, like I don't know, it's probably like a 90% Uber. I have no clue, 10% Lyft. But anyway, I did think this is interesting. So just for like context of where they're still underpenetrated, because they are slowly getting penetrated in the world, right? Trips outside of London and Paris are growing 3 to 4 times faster year over year than in the cities themselves. So you're seeing more of a rural push finally. This was always going to happen on a big leg because you need the density of drivers in order to actually make it superior to just driving yourself or getting a cab. Right? You need drivers to be floating around you. That's one of the reasons why they get there quicker and cheaper. Is the network size, and so it's harder when there's less dense people to get that same network effect. So we're starting to see it. So I think that's important. And they did say here that there's other things like now that they're offering reserve, so people that live far away can reserve at the time in the future, and then the car will show up. It helps Uber dispatch as well, so it reduces costs probably for the user and also for the driver. So I think that's something that's still going on as we speak. Uber One, so that's a platform that's pretty strong. They're getting some pretty good growth there year over year. And they do generate members spend 3 times what non-members spend. So if they can get more and more people on Uber One, they spend a lot more money and take more trips, spend more on Uber food delivery, right? And then obviously the ad scaling, which grew 80% year over year. So this tells me that there's still a lot more growth to go, which should tell me that delivery is going to keep slowly chewing up in EBITDA margin, because that's one of the reasons I think Uber is more profitable than the other delivery platforms, is because they were better at advertising, and partially because of their size, and all the restaurants know what Uber is, right? In terms of the revenue growth, obviously it's gone from 3 billion to 37 billion in 7 years. Uber, when it IPO'd, was losing money like crazy. Was actually always losing money like crazy, and then it finally, like COVID did them no favors, obviously, and they pivoted hard. And then they literally, like I said, delivery was like 10% of the business, and now it's like, I don't know, half or something. It was like a crazy pivot, a crazy decision-making abilities by the management team of Uber during that critical time, while cutting 25% of the workforce. So it was crazy. So anyway, there should be books written about that transformation. But and you're starting to see scale again over time. What else? IMAX. We'll go to IMAX. So this one, like I said, we're in it at what, 15? It's not 23. IMAX is special. So how can I word this? There's a lot of great things about IMAX. First thing I always look at is what do they do with the cash flow. They bought back 20% of themselves since COVID. So I'm always a sucker for buybacks. It tells me they have a lot of cash to buy back themselves at relatively cheap prices. Or else I would be looking at the company. What else is there? Strong backlog. They still have a lot of share to take. What I like here is 40% target for total adjusted margin. So right now they're in the 30s, like high 30s. So I think they got into 39 in Q4. So getting over 40% margin helps me. Now this thing does scale with box office numbers, which have been all over the place. I mean, you had COVID, then you had the shutdowns, like the lockdowns. You had the strikes, which all impacted it, right? Then you had the whole like way too much content on streaming platforms, which they're all pulling back from, right? So it was actually eating into their the producers themselves was eating into their the box office numbers. Anyway, what I like for over time is superior products. I want to see market share go up over time, and it has. You can see it's kind of way stronger on the domestic side versus say before. Let's call it an average of 3. Now they're at 5 for domestic. So they continue to take share because it's a superior business model. If you want your movie to do better, you want it on IMAX. So, and I think that's just going to continue, especially domestic. China's been a bit of a miss. And we'll go into that number in a bit. It's partially because of how weak China is overall, and how weak the economy has been there. And for 2025, what gets me excited is you literally have a number of titles for your film for IMAX program. You literally have stuck at 8, and then all of a sudden you're shooting to 14 this year, 2025. So I think that's a big catalyst for just more box office wins, more notoriety for the IMAX platform, right? I mean, there's a reason why James Cameron and all these big developers or directors just like say like IMAX, you got to shoot in IMAX, you got to do it in IMAX. There's a reason why, because it's the reason why they get the big numbers, like the real blowouts. In terms of the slate for 25, it's pretty strong. It's probably, I mean, last year you had to remember going into Q1 and Q4. So this next quarter and Q1 2025, you're literally comping the strike. So there was literally very little production for the next bit here. Whereas last year they were comping, this Q3 they were comping Barbenheimer. So Barbie and Oppenheimer. So you're literally going to see comps get really easy for the first bit here, probably for the next 6 months. And then we'll see how they do. I mean, it's not like 2024 was a great year for films. It was kind of all over the place. They do have a couple interesting ones, right? Captain America, Michael, Thunderbolts, Superman Legacy, Fantastic Four. But it is interesting. I'll be interested to see how they do. Another thing that I like about IMAX is how global they are. So they have a pretty diverse footprint, and they're able to tap into what's currently happening is a lot more local language films, and they're growing, and they're getting better too. The quality of the films have only improved with the success of them, and I think that's only going to continue over time. People are more proud of their nations, and they're trying to protect their culture, and I think this is just another way. And I think the cost of producing films has gone down, at least for average films. If you want to do it in your own currency in your own country, it's a lot cheaper than hiring a Hollywood actor and doing all the Hollywood gimmicky stuff and all the big explosions. You can do a lot of stuff with technology now that you don't necessarily need a big budget, especially for a local language to succeed, right? Anyway, you can see that the trend has just been pretty crazy, just shooting up 2023 and shooting up, staying up there in 2024. So that tells you that the trend is there to stay, and IMAX taps into that very well. I thought this slide was really good. It just helps show what skews the margins. So when there were shutdowns, and production curtailments, we saw the margins suffer. And there is an 88% coefficient to box office numbers. So a strong box office number does shoot up the EBITDA margin. So it does ride on box office numbers, but it's not all the business. And we'll go into the breakdown in a bit. Here's just the shares outstanding. I mean, just goes without saying, you can buy 20% of yourself since 2020. It's just nice. And the average price was 15.24, which is actually ahead of me at 15.38. So they've also been buying it when it's smart to buy. That's what I'd say. This is a nice breakdown of how they make money. We're not going to go into all the details. We did a video on this, so I'm going to post them both underneath this channel just to help people who want more information on it. But you can see 34% of total revenue for 2023, just a while ago. It's content solutions, and 63% is technology products. So content solutions is basically just percent of box office filmed in the IMAX network, and it's recognized as the box office earned, so very linear. Here you have actual agreements with global exhibitors. So that's more of them making joint agreements like this one, where they're splitting the revenue from the box office. There's other ones where they're going to get, so here they have contracts, contingent consideration estimated based on future estimated. So basically the exhibitor is paying IMAX a fixed amount based on something they agreed to over the 10 to 12 year contract, based on what they thought box office receipts would be. So that tells you that part of the business is more fixed and part of the business is more variable. Obviously, when the box office is hotter, it does better for everybody involved because these guys, exhibitors, are the counterparties to these contracts, so you do want them to be around. You don't want them all to go bankrupt or, I don't know, on the ropes. You want a healthy environment for the exhibitors, but also for the producers of the content. So it's not like they don't have their own counterparty risk here if, say, exhibitors were to see more and more trouble and, say, box office is really going away and streaming is just no one wants to leave the house anymore. Then you could still see a problem with IMAX just because of the counterparty risk with the exhibitors. But we haven't seen that. It hasn't happened. And relative to the exhibitors, their business model is slightly superior because technically IMAX will get paid a little bit fixed amount regardless of how the box office performs. More so than the exhibitors themselves would, and their balance sheet's better, which we'll jump to in a second. What else? Greater China was 25% of IMAX's revenue. So IMAX, the reason why we did the video, I think, back then was because we wanted more exposure to China, because we know China's been weak for so long. We know that eventually it's going to rate of change positive. It hasn't happened, but eventually it will. You can't just go down forever. So what I like here is it's a way to get a good business, a good brand with exposure to China while the business is still putting up record numbers. So despite China being shit, they're still putting up strong numbers internally. In terms of the balance sheet, I do want to point out here that they do have the convertible notes, which is an interesting one, and I don't run into them too often. It's a very low interest rate, but the conversion rate was at 28, but then they did maybe I'll do a deep dive on convertible notes at some point. But anyway, they have a capped call on them, which basically put the initial price cap up to a $37 conversion rate. And the idea there was to reduce potential dilution resulting from the common shares being issued when they convert. So they do have convertible debt. Again, very cheap interest rate. So what it is a source of dilution if the price gets relatively high. I mean, a lot higher than it is now still. I mean, 37, what are we at? 23 or something? Yeah. So still a ways to go on that front, but it could limit upside until it's dealt with. And the thing is maturing in 2026, so we don't want to know what they're going to do with it after that. What else is there? Cash flow. I mean, you're still putting up pretty strong CFO. You're putting about 20 million back into the business, right? So you're making 60, putting 20 in. So let's say they make 80, put in 30 in. They're net 50, and then what they're doing was it's buying back shares, right? So 18 plus 30 is 48 against 59. So basically, most of the cash is going to investing in themselves, and then investing in buybacks. I guess buying back shares. We have started to see them pull it on the revolver as well, which could be interesting. Maybe they're starting to think about how they want to deal with the convertible in 26. This is just footprint language from the call. Just how underpenetrated they are. So you can see Saudi's footprint. They think there's 10 currently, and they think they can get 50 in the years ahead. Again, this is very underpenetrated in places that are going to likely promote their own local language products. Like I think Saudi Arabia will. I mean, you can say that again for Japan and Latin America. I mean, we've seen Japan just crush it in terms of local language, especially not even in Japan, just all over the world with anime. What else is there? I mean, I think it's just, again, local language in China. China's going to try to promote local language films, just like America will try to produce made in America films. What else is here? I did start seeing that, excluding the share-based comp, we're starting to see some improvement year over year in costs. So we're seeing cost containment while we're seeing the recovery of the box office slowly over time. Though again, any quarter, it's very noisy because some quarters have really good, like say the Barbenheimer in Q3 last year was amazing, right? And then you have certain movies that actually put up pretty good numbers, but not to that degree. So, and they have to comp that, so you have to keep track of where the comps are, because I found that the stock likes to react to the quarterly noise a lot more than the long-term trajectory of the company, which has been up to the right over time. And they did say that they're starting to see, this is a little soundbite here, I think studios and filmmakers are understanding that its IMAX release is kind of like a beachfront property. You want to reserve a place, you've really got to do it early. And that's just them saying they also have started to lock in movies for 27 and 28. So movie makers want to be on IMAX, right? They see it as a way to help ensure success, so they don't bomb, or they're less likely to bomb if it goes on IMAX or filmed on IMAX. So they're also trying to lock that in, which just helps the IMAX platform. It just helps them get more share over time. So And I do think the premiumization of experiences, like when you have your convenience at home, if when you want to go to a movie, you want to experience a movie or see something you can't see at home, and IMAX is that superior quality. So I think people will continue to pay what they are when they want to go out. And I think the exhibitors are still probably a little bit in trouble just because they have so many theaters to try to fill up. I know this is going to be hard to do in the long run, but I mean, it's tough to say. But I mean, this business relative to say a Cineplex, which you've written up, as well as a couple others, is just superior in terms of the balance sheet and the business model. But it still has that same rider on a box office recovery, if that's what we were playing for. But we don't even need it at this point. And we do have the CEO owns 6%, and the other guy owns 16%. So still quite a lot of insider ownership. We're already at 24 minutes. I'm going to call it here. I got to go through Mobileye and a couple more. I think we got Amazon tonight too. I haven't even read Roku, so I got to go through a lot more calls. I hope you guys like it. Just my random thoughts, not edited, or just saying what I think as it comes to my mind. And have a great rest of your day, and happy Halloween.